Good evening. Please come to one very important question 48 number. Keep 48 number in front of you. The balance sheet of Professional Limited and Dynamic Limited. First column is Professional, second column is Dynamic. As on 31st March, 20x2 is given below. Asset first column Professional Limited, second column Dynamic Limited. Then property, plant and equipment, investment, current asset, inventory, financial asset, trade receivable, and then cash and bank. In Professional Limited, how much is cash written? 250. Make it 200. Otherwise, your balance sheet will not tell you. Cash and bank 200. Now check the total whether it is 2000 now. After writing 200, equity and liabilities. Equity, share capital of rupees 100 each. What is the face value? 100 rupees each. Reserve and surplus, OCI. Then non-current liabilities, long-term borrowing, long-term provision, deferred tax. Current liabilities, short-term borrowing, trade payable, total. Other information, Professional Limited acquired 70% of Dynamic Limited. 70% means, tell me how many shares? How many shares were acquired? Dynamic Limited had 4 lakh shares. Figures are in lakhs, okay? So 4 lakh into 70% shares were acquired. On 1st April 20x2 by issuing its own share in the ratio of 1 share of Professional Limited for every 2 shares of Dynamic Limited. So they have issued their own share in the ratio of 1:2. The fair value of the share of Professional Limited was 40 rupees. So this point number A will help us to calculate the consideration transferred. Okay. So first consideration is in the form of equity shares. And this calculation I have written for understanding. 4 lakh share into 70%. These many shares were acquired. This is share exchange ratio. And this is the issue price, 40 rupees. So what is the answer for this calculation? Hanji? Is it 56? Point number B. The fair value exercise resulted in the following. The property, plant, equipment fair value on 1st April 2002 was 350. So tick mark PPE of Dynamic Limited at the top, first line, second column. That figure of 500 will become 350 actually. Okay. So how much is the change in the fair value of this PP? Reduction by 150. Next is Professional Limited agreed to pay an additional payment that is higher of 35 lakh and 25% of any excess of Dynamic Limited in the first year after acquisition over its profit in the preceding 12 months. This amount will be due after 2 years. Dynamic Limited has earned 10 lakh profit in the preceding year and expects to earn another 20 lakh. So my question is, how much additional consideration you will take here? Or you can say deferred consideration. Additional consideration. Deferred consideration. Will you take 35 lakh or will you take 25% of 20 lakh minus 10 lakh? 35. And when it is payable? It is payable after 2 years. So we have to divide by discount rate. Where is discount rate? Search for discount rate in the problem. If it is not given, we will assume some rate. Okay. So let us say we'll assume 10%. So the present value of this additional consideration will be based on 35, higher of the two. 35 lakh or excess profit. So how much it comes to? 28 point? Something like this. Okay. So the point number B will help us to compute additional consideration. I will take either 35 or 25% of excess profit over preceding year profit. So this figure is very high. Point number C, in addition to the above, Professional Limited agreed to pay one of the founder shareholders a payment of rupees 20 lakh, provided he stays with the company for 2 years after the acquisition. Will this also be considered in the consideration? No. Why? It is the payment made for future service. It is a payment that they are going to make for future service. So therefore it will be treated as post combination expense. This will not be taken in purchase consideration. Next, point number D. Dynamic Limited had certain equity settled share based payment award, that is original award, which got replaced by new awards issued by Professional Limited. As per the original term, the vesting period was 4 years, and as of the acquisition date, the employees of Dynamic Limited have already served 2 years of service. As per the replaced award, the vesting period has been reduced to 1 year, that is 1 year from the acquisition date. The fair value of the award on the acquisition date was as follows: original award 5, replacement award 8. This we will consider. Yes or no? So what is the share based payment award we will consider? For example, don't write, we'll write properly. The formula is fair value of original award into number of years completed divided by higher of the two. Which higher of the two? Original vesting period or total vesting period? Total vesting period is 3 years. Original vesting period is 4 years. How much it comes to? 2.5. So that also I will add. Then it says Dynamic Limited had a lawsuit pending with a customer who had made a claim of 50. Management reliably estimated the fair value of the liability to be 5. So we have to record one more liability. Which liability? Contingent liability. Contingent liability will be recorded at fair value. Fair value is reliably measurable and we assume there is a present obligation. In yesterday's one problem, it was not very clearly mentioned that it was a present obligation, but it was given a hint that company believed that the case can be defended successfully. This question is silent, so we will assume present obligation, past event, fair value can be measured. So one more liability will come in our books now. Applicable tax rate for both entities is 30%. What is the use of the tax rate in this problem? When do we require DTA calculation? When we are recording asset at a different amount, like for example PPE, the book value is 500 but we are going to record it at 350. So this will give rise to DTA. And a liability relating to a customer, that liability is not there but we are going to record it. So today it will be disallowed, but in future it will be allowed. So that will also give rise to DTA. So both items will give rise to DTA. So that also I will include in my calculation. Is it right? So what is my step number 1? Consideration transferred. Computation of consideration transferred. Under that, write A. Fair value of shares. Fair value of shares issued. Fair value of share issued. Write this calculation which we discussed. 1/2 into 4 into 70% into rupees 40. So 1.4 lakh share. Figures in rupees in lakhs write down. Rupees in lakhs. 1.4 lakh shares into 40. Okay. 56. Now see in this question, face value is 100 rupees. Face value is 100 and you are issuing share at 40 rupees. So there is a huge discount involved here. So when you will pass the entry at face value, your entry will not tally. The difference is discount, but we can't record discount. So we will adjust it in reserve and surplus. Okay. So the discount that you have given at the time of issue of share will be adjusted in, say, reserve and surplus. Point number B, fair value of deferred consideration. Fair value of deferred consideration, 35 we will pay, higher of the two, into PV factor in bracket 10% comma 2 years is equal to 35 into 0.826. Approximately, are you getting 28.91? And remember, we are not going to incorporate that professional, the fees payable to founder shareholder 20 lakh because that is related to future services. That will be post combination expense, right? So point number C, write down value of services or value of share based payment award. Value of share based payment award as per business combination 5 into 2/4. How much is that? So what is the total? Total 87.41. Which is contingent consideration? There is no contingent consideration. There is a contingent liability. That liability will form part of my net identifiable asset acquired. So point number step 2, computation of net identifiable asset. Be present every day so you'll understand. The last point, adjustment number E, was not a contingent consideration. It is a contingent liability that we have to recognize now. Now, how will you calculate this net identifiable asset? There are two ways you can do it. Either you can make a list of all the assets minus all the liabilities, or you can just take share capital, reserve and surplus and make fair value adjustment. So that will save some time for us. So write down, dear student, first write down share capital 400. Keep writing. Share capital 400. Reserve 180. Reserve 180. OCI 45. This gives me the fair value of, this gives me the carrying amount of the net asset. Correct? This gives me carrying amount of net asset, and then write down less decrease in value of PPE. Decrease in value of PPE. 500 minus 350 in bracket 150 less new liability. New liability, what is that new liability? Provision for lawsuit. That is 5. And then write down next point F. Since you have recorded two new assets and a liability, one new asset and one new liability, in case of PPE, this is carrying amount, this is fair value. Tax laws will allow you deduction on 500, but for accounting purpose, you will record at 350. So higher carrying amount in tax books, tax base is higher, this will give rise to DTA, and in case of liability, opposite. Okay, 0 versus 5. 0 versus 5. So 5 will be allowed in future. Whenever this expenditure will be paid, you will be allowed. So that will also give rise to DTA. Both will give rise to DTA. So in this example, because tax rate is given, and this is question is simple, we can also incorporate DTA. Is it right? So how much DTA we will create? 46.50. So this will give me net identifiable asset acquired. This is net identifiable asset acquired. How much? 516.5. In this question, non-controlling interest is 30%. But they have not mentioned about fair value of non-controlling interest. So what we can do, we can take this as a basis for calculating the NCI. So point number G, write down NCI. 30% of 516.50, 154.95. Because we have to prepare the opening consolidated balance sheet, I need this figure also. Now write down step 3, goodwill oblique gain on bargain purchase. Goodwill oblique gain on bargain purchase. Under that you write down A, consideration given. Go to step 1. Consideration given in step 1, is it 87.41? Point B, add NCI. Add NCI. How much? 154.95. Less identifiable net asset acquired. Less identifiable net asset acquired, 516.50. Step number 2. This NCI is also step number 2. A plus B minus C. Is it positive or negative? Negative. Oh, gain on bargain purchase, 274.14. So this I will reduce from the reserves. Okay, or add in the reserve, sorry. This we will add in the reserve. Now write down one more question in your question, number 48. Add one more question from my side. Kindly pass journal entries. What will you write? Kindly pass journal entries. Written. So let us write journal entries. In this first journal entry, I am going to take over all the assets at fair value, liabilities at fair value. I will also incorporate DTA. I will also incorporate gain on bargain purchase. I will also incorporate NCI. Is it right? So in one entry, we will first incorporate all assets, all liabilities, NCI, DTA, gain on bargain purchase, and consideration payable. So write down, keep the balance sheet of Dynamic Limited in front of you. The second balance sheet, start from the top. PPE account debit will take fair value. PP account fair value is given. So take fair value. Investment account book value 100. Inventory account debit book value 150. Financial account debit book value, how much is that? 230. Trade receivable account debit book value 300. Cash and bank book value 100. Deferred tax asset step 2. Was it step 2? Yes. 46.50. And then you write down credit side to provision for lawsuit 5. Come to liability side. Last 5 items, first copy at book value. To long term borrowing 200. To long term provision 70. To deferred tax liability 35. To short term borrowing 150. To trade payable 300. So these are the 5 liabilities. One extra liability I have recorded, which was assumed in business combination. And I will now record to NCI 154.95 already calculated. To consideration payable 87.41. To gain on bargain purchase 274.14. Only cross check the total is matching or not. Should match ideally, because first we have prepared the working notes and then we have passed the entry. So ideally it should tally. Tallied. Okay. So after this I am going to pay this consideration 87.41 by issuing shares. Okay. And by treating 28.91 as deferred consideration and by treating 2.5 as share based payment reserve. But when I look at the entry, I find, oh, there is a difference on the debit side. So that difference we will adjust in reserve and surplus. Because face value is 100, but you are issuing it at 40. So maybe some misinterpretation in the question. Either they should have written face value 10 or 400 rupees issue price, no problem. Consideration payable account debit 87.41. Reserve and surplus account balancing figure 84. Reserve and surplus account balancing figure 84. To equity share capital 140. To equity share capital 140. To deferred consideration payable. Why 140? You write 1.4 into 100. 1.4 lakh share multiplied by 100. Number of share issued was 1.4 lakh. Face value is 100 rupees. And then write down to deferred consideration payable 28.91 to share-based payment reserve 2.50. So while calculating reserve and surplus for consolidated balance sheet, reduce it by 84. Okay. Now we'll prepare the consolidated balance sheet of Professional Limited as on 1st April 20x2. So what you do, dear student, first you draw this format quickly. Same format in as much detail as you can. More the detail, better. Right. Okay, format is ready. Keep the same format, but few more items will come in this balance sheet. Like for example, NCI will come, deferred consideration will come, then provision for this lawsuit will come. DTA and detail we will net off. How can we net off? It depends. So assuming that the conditions for net off is satisfied, or you want to write separately, you write separately. Because we don't know the conditions. So I hope the format is ready. First we will write note 1 share capital below this SOFP. So note 1, have you drawn the format? No. Okay, draw first. First and fast. It takes a lot of time to prepare financial statement format in the exam. Okay. Examiner should give you printed format. In CPA exam, it happens that software gives you the SOFP in the beginning only you put the numbers and it generates the total. Okay. Yes. In CPA exam, you have to prepare the SOFP profit and loss also on the computer only, but it is a pre-decided format. You don't have to draw the format, it is already given there. You only have to put the numbers and you don't have to take total also. It's like your income tax return format nowadays. Okay. Everything is pre-decided, or you have to put the numbers. So let us start this wonderful answer. First write down share capital. Share capital, write down issued and paid up capital. In the given SOFP, there are 5 crore shares and you have issued 1.4 crore shares. So 6.40, 5 plus 1.40. 6.4 crore equity share of rupees 100 each fully paid up. 640. Then out of above, out of above 1.40 crore shares have been issued for consideration other than cash. Out of above 1.40 crore shares have been issued for consideration other than cash. This 640 you write in the SOFP. Share capital 640 write down. And then you prepare one. Note number 2. Other equity. In other equity, you first write down reserve and surplus. Reserve and surplus. Reserve and surplus opening balance. Can you see 730? Professional Limited. Start from there. Less loss on issue of share 84. For this question, this much is enough. This is ACCA only. Less loss on issue of share 84. You can prepare in ACCA format, no problem. Then separate columns you have to draw. And then you write down OCI 80. OCI 80. Share based payment reserve 2.40 50. Share based payment reserve will also come in ACCA, other equity. Gain on bargain purchase also you will add. How much was gain on bargain purchase? 274.14. Check. So this also you add it here. Total comes to 1002.64. Is it right? Total is right. Transfer it to the main answer. And now you complete the main answer. Check on the screen one by one. Property plant equipment will be 300 plus 350. 300 professional, 350 dynamic. Market value, fair value. 650. Investment, both companies book value 400 plus 100, 500. Inventory 250 plus 150, 400. Financial asset 400 plus 230, 630. Trade receivable 450 plus 300, 750. Cash and cash equivalent 200 plus 100, 300. Total is 2080. Cash of Professional Limited is 200. Is it 2080 or no? I think no. Just 32, right? Just 3230 is right. Okay, try the liability side. Share capital, other equity I have written. NCI is how much? NCI. Hello, NCI. Nobody is answering. 154.95. 154.95. 154.95. Non-current liabilities. Financial liabilities. Long-term borrowing 450. Others deferred consideration 28.91. So this will come in non-current liabilities. It's payable after 2 years. Long-term provision 120. Deferred tax, what I will do? I will take 40 plus 35 and I will also adjust this 46.50. Okay. Deferred tax asset. So net deferred tax liability is 28.50. Short-term borrowing, simple total 250. Trade payable, simple total 550. Short-term provision provision for lawsuit 5. Now if you take total, it should tally 3230. Only we have given the effect of the journal entries, right? Write a note. It is assumed that deferred tax asset can be set off against deferred tax liability for presentation purpose. DTA can be set off against DTL for presentation purpose. Now we will take the last part, 2 questions on reverse acquisition. In your theory part, in the beginning, we had the discussion on reverse acquisition. So you will come to that paragraph, which is in your book, paragraph number 10. Okay, reverse acquisition means the company which issues shares gets less number of shares in the combined entity, and the company to whom shares is issued gets a majority stake in the combined entity. So for accounting purpose, the one who has control will be treated as acquirer, even though for legal purposes the one who issues the shares is treated as acquirer. So write one small example for understanding reverse acquisition. In the notebook, write down. Keep that page open. Many paragraphs will not be required to write again. So dear student, take out a notebook. Heading: reverse acquisition. Example. Write example. Theory part is printed there. We'll take an example and then we will solve 2 questions also. A Limited merged. Example, right? A Limited merged with a relatively small sized company B Limited. A Limited merged with relatively small sized company B Limited. The legal acquirer B Limited has 1 lakh issued equity capital. The legal acquirer B Limited has 1 lakh issued equity capital. Okay. It issues 10 lakh equity shares. It issues 10 lakh equity shares to the shareholders of A Limited. It issues 10 lakh equity shares to the shareholders of A Limited. Next line. Draw this table to understand the, write down shareholding percentage. Then you will write down right hand side 2 columns, numbers, percentage. Now let us examine the shareholding percentage. A Limited's members, now they will be holding 10 lakh share and B Limited's members will be holding 1 lakh shares. Total 11 lakh. If you look at the percentage, approximately 91% shares are with A, 9% shares are with B. Who is the legal acquirer here? B. Legal acquiree A. But for accounting purpose, this standard says, look at who is getting the control. Who is getting the control in this merged entity now? A Limited. So for accounting purposes, A Limited will be treated as accounting acquirer and B Limited will be treated as accounting acquiree. Okay. So write down, shareholders of A Limited get the largest portion of voting rights in B Limited. Shareholders of A Limited get the largest portion of voting rights in B Limited after business combination. After business combination. A Limited is a legal acquiree. A Limited is a legal acquiree, but accounting acquirer, right? And B Limited is legal acquirer, but accounting acquiree. So now the problem is, the standard says the assets and liability of the accounting acquiree taken over will be recorded at fair value. But who is the legal acquirer? B. We are in the books of B only. We are in the books of B. But for accounting purpose, you have to visualize as if we are in the books of A. Only visualize. Okay? And then you will take over the assets and liabilities of B at fair value and take over the assets and liabilities of A at book value. So while passing entry in the books of B Limited, A Limited's assets and liabilities will be recorded at carrying amount, book value, and B Limited at fair value. So that is a small change you have to do. In reverse acquisition, and that I am going to dictate you how to do that, journal entries. In reverse acquisition, the accounting acquirer, A Limited, in our example A Limited, usually issues no shares to the owners of accounting acquiree. Usually issues no shares to the owners of the accounting acquiree, that is B Limited. Usually issues no share to the owners of accounting acquiree, in bracket B Limited. Now, don't write for some minutes. This thing is printed in your book. Instead, accounting acquiree, B Limited issues shares to owners of accounting acquirer. This you can write. So this example will complete in your notebook. Instead, accounting acquiree B Limited issues shares to owners of accounting acquirer. Issues shares to owners of accounting acquirer. Right? Issue shares to owners of accounting acquirer. So let us first visualize what we have done. A Limited is legal acquiree, but accounting acquirer. B Limited is legal acquirer, but accounting acquiree. Okay? Legal acquirer will issue shares. Accounting acquirer usually does not issue the shares. The assets and liabilities of accounting acquirer will be at book value. Assets and liabilities of accounting acquiree will be at fair value. Okay? That's it. Now this line I have written in your book, paragraph 10. First line. A reverse acquisition occurs when the entity that issues security is identified as acquiree for accounting purpose. The entity whose equity interests are acquired, that is legal acquiree, must be the acquirer for accounting purpose for the transaction to be called as a reverse acquisition. For example, reverse acquisition sometimes occur when a private limited company wants to become a public entity but does not want to register its equity share. So this is backdoor listing. You merge with an existing listed company and design the share exchange ratio in such a manner that ultimately you get the control over that company. So without undergoing the long legal procedure, this is a shortcut to become a listed company. Of course, not as easy as it appears to be. Okay, because the SEBI is also very smart. To accomplish that, the private entity will arrange for a public entity to acquire its equity interest in exchange for the equity interest of the public entity. In the given example, public entity is acquiree for accounting purpose and private entity is acquirer for accounting purpose. Next point. First condition you have understood. Second condition is that this chapter is applicable when the accounting acquiree must meet the definition of business. Otherwise, whole discussion is waste. Okay. The accounting acquiree must meet the definition of business for the transaction to be accounted for as reverse acquisition. And all of the acquisition and measurement principle of IFRS 3, including the requirement to recognize goodwill, will apply. Now, how will you calculate the goodwill here? Goodwill will be calculated by first calculating the fair value of accounting acquiree's business. Is it right? Fair value of accounting acquiree's business and comparing it with the fair value of net asset. Fair value means we'll take the share capital multiplied by share price. So that is fair value of the accounting acquiree's business compared with the fair value of net asset. The difference is goodwill or gain on bargain purchase. Okay, we'll take one example. Fair value, write down some notes. With numbers only, student of account gets activated. Yes or no? Yes. Student of account just want numbers, nothing else. So write down steps in reverse merger. Steps in reverse merger. Step 1, identify reverse merger. Identify reverse merger. When it is a case of reverse merger, a simple test is if the legal acquirer issues more than its own capital. Legal acquirer issues more than its own capital. It is a case of reverse merger. True or false? If you have 1 lakh share, but if you have issued 1,10,000 share, so automatically the other party will get more than 50% share. So he will get the control. Then step 2, write down in the journal of legal acquirer. In the journal of legal acquirer. In the journal of legal acquirer. Now case 1, write down absorption. Absorption means one company absorbs the other company. So one company will continue. The other company may come to an end, will come to an end. That is called absorption. So write entry number 1. entry number 1. See, one point is very clear. We will pass entry in the books of legal acquirer only, because legal acquirer will continue. Legal acquirer in the eyes of law will continue. The legal acquiry will come to an end. Okay. So in the books of legal acquirer, what I have to do, two principles I have to remember, that the assets and liabilities of legal acquirer must be at fair value. Legal acquirer. And assets and liabilities of legal acquiree must be at book value. But we are in the books of legal acquirer only. So what I can do, I will first reverse. What I will reverse? All the existing asset, liabilities, reserve and capital, and make them zero. Again record them at fair value. That is one way. The second way is you can only pass the entry for the difference. Whichever method you find convenient, follow. This is simple, you will not make mistake, and for every student this will become a simple method. It is very easy to reverse the entire balance sheet first, make it zero, and again incorporate all assets and liabilities at whatever fair values they have given. You can also incorporate goodwill in this calculation. Sundry liabilities account debit book value. Reserve and surplus account debit book value. Share capital account debit book value. To sundry assets, reserve and surplus means other equity, OCI, whatever is given, debit. To sundry asset book value. Being assets and liabilities etc. of legal acquirer eliminated. So now the balance are zero. Start fresh. Okay. This is only for accounting purpose. Step entry number 2, write down. Entry number 2. Incorporate assets and liabilities etc. of accounting acquirer at book value. So now I am going to incorporate the assets and liabilities of accounting acquirer, means legal acquiree, at book value. Sundry asset account debit into bracket book value. To sundry liabilities in bracket book value. To share capital account. Write down in bracket agreed shares or share capital of accounting acquirer at book value. So in examples will be given how many shares will be issued. So take those many number of shares issued. Or share capital of accounting acquirer. If this number is not available, then you take the existing share capital of the accounting acquirer. And if there is a difference, it will go to reserve and surplus, not goodwill, not gain on bargain purchase, because here we are assuming mentally that we are in the books of acquiree. Which acquiree? Legal acquiree. We are in the books of, mentally we just assume, notionally assume, we are in the books of accounting acquirer. That is easy to understand. And since you are an acquirer, you can't record goodwill for your own assets and liabilities. Now in the next entry, you will incorporate the assets and liabilities of legal acquirer into bracket accounting acquiree at fair value. Incorporate assets and liabilities etc. of legal acquirer at fair value. At fair value. So now we'll bring back those same assets and liabilities which we had eliminated in the first entry at fair value. So whatever fair values they will give you, now you record. So sundry assets account debit, fair value. Then you write goodwill account debit balancing figure. Now this will give rise to goodwill or gain on bargain purchase. Okay. To sundry liabilities fair value. And to consideration payable in bracket fair value of business of legal acquirer. What is fair value of business? Number of shares into market price. Consideration payable हो गया, number of shares into market price. Entry number 4. Entry number 4. Consideration payable account debit. To share capital in bracket that is agreed. You will take actually the same number of shares which is appearing in the books of the legal acquirer. Okay, share capital will remain same and balance you adjust in equity to other equity account. Right. This share capital, what you will do, whatever is appearing in the share capital of legal acquirer, that you can't change. Okay, we'll solve a problem. But before that, I will also give you entries for case 2, amalgamation. Now, what is amalgamation? Amalgamation is like this. A and B, they merge their businesses together and form AB or C, whatever. And after this, who is the legal acquirer here? AB. B is legal acquiree. A is legal acquiree. But it may happen that B controls this company. The shareholders of B controls this company. So in that case, B will become accounting acquirer and this will become accounting acquiree. Is it right? So when B becomes accounting acquirer, assets and liabilities of B Limited will be recorded at book value and assets and liabilities of the other entities other than B will be recorded at fair values. Okay. So you identify who is the accounting acquirer. If many companies merge together, who gets the control? His assets and liability will be at book value. All other merging entities at fair value. So dear student, now write down list of journal entries. Entry number 1 is not required because you are going to pass entry in the books of a newly formed company. So already there is zero asset and liability. So is there a need to reverse? No. Entry number 2, 3, 4 will be same. Entry number 2 means record the assets and liabilities of B Limited at book value. Entry number 3 was record the assets and liabilities of A at fair value. And entry number 4 is discharge the consideration to A. So write down, however, in the fourth entry, the number of shares issued will be based on fair value of the business of legal acquirer, into bracket at the other entities in this example, or other entities. Like in our example, if A and B are merging, forming a company C, I will take fair value of business of A Limited. Drafting of the formula is little doubtful because legal acquirer will be AB. But I have to take the fair value of business of A, this company, because we have to issue shares to A. Divide by, okay, we'll come back to this. First write down fair value of business of other legal acquiry, write down. Am I right? Other legal acquiry. Other legal acquiry. These formulas are not official formula, okay? These are our creativity, teacher's creativity. If B Limited is treated as accounting acquirer, then A. Upon fair value per share of accounting acquirer. Upon fair value per share of accounting acquirer. So we have to issue shares to A Limited. 10,000 is their value. Fair value, one share of B is 50 rupees. So 10,000 divided by 50. Those many shares will be issued. Write a note and move forward. This calculation is not required in the case of absorption. This calculation is not required in the case of absorption, as the number of shares will always be given. Number of shares means it will appear in their respective SOFP. Is it right? Legal acquirer's figure will already appear in the SOFP in case of absorption problem. In amalgamation problem, we have to issue the shares. Therefore, formula will be required. In absorption, it is there in the SOFP. No. Immediately, I will give you a small example to prove my point. See, just first on the screen, entity A is legal parent, accounting acquiry. Entity B is legal subsidiary, but accounting acquirer. So now you see the legal parent, they will give you the number of shares in the balance sheet. So this number of share is already there in the absorption problem. 100 share. Legal parent number of share will be 100 only. Will it be different? No, you can't change this figure. This is already there in their books. Only for accounting purpose we are doing this fair value accounting. But if the two companies merge, for example, then how many shares will be issued to A will depend on the fair value of business of A and fair value per share of B. So now you come to question number 37. We'll solve this, you'll understand. Whatever minimum doubt you have or maximum doubt you have, with this example, all those loose ends will be plucked. Okay. Because to visualize so much is also a challenge. Now we will come to question number 37. Whatever theory I have written, I will apply that in this problem. This is a case of absorption. On 30th September 20x1, entity A issues 2.5 shares in exchange for each ordinary share of entity B. Who has issued to whom? A to B. So who is the legal acquirer? Pay attention, you will understand. This is one more chance to understand. Who is legal acquiree? B. Okay. Entity A issues 2.5 shares in exchange for each ordinary share of entity B. All of entity B's shareholders exchange their shares in entity B. Therefore, entity A issues 150 ordinary share in exchange for all 60 ordinary shares of entity B. So how this 150 has come, you will understand. 60 into 2.5, that is share exchange ratio. For one share, 2.5 shares were issued. So for 60 share, 150 shares were issued. If in the exam this ratio is not given or this number is not given, this is how you will calculate it. The fair value of each ordinary share of entity B is 40 and the quoted market price of entity A's ordinary share is 16. So if I look at their ratio of fair value, it is 2.5:1. Is it right? Sometime in the exam they can simply give you this paragraph and they will say share exchange ratio is based on the fair value. Okay. Then the fair value of entity A's identifiable asset and liabilities on 30th September 20x1 are the same as their carrying amount except the fair value of entity's non-current asset, which is valued at 1500. So you tick mark entity A second line non-current asset, which is appearing 1300 below in the balance sheet. Can you see this 1300 here? Tick tick. It will become 1500. Statement of financial position of A and B immediately before the business combination. Now this is their SOFP before business combination entries. Entity A, entity B. Now first we should check whether this is a case of reverse merger or not. So the answer is yes. This company has 100 shares A, but it has issued 150 shares. It has issued 150 shares. So that means you have issued more than your own ordinary share. This is a case of reverse merger. So A is legal acquirer but accounting acquiree. B is legal acquiree but accounting acquirer. Right? Then this is their respective SOFP. Nothing to be explained here. Then what is the question? Question is prepare balance sheet. Prepare SOFP. Write down prepare SOFP after passing journal entries. Prepare SOFP after passing journal entries. Journal entries in the books of whose book you are going to pass the entry? A or B? A. In the books of A. A will be there. Even the SOFP will be issued in the name of A only. In the notes to account, you are going to disclose that this is a continuation of entity B. Okay, in the notes to account, when you will prepare, not now, after you qualify, then you will disclose that this SOFP is a continuation of entity B. That note I will dictate later. First, to write down one note. We are starting this answer. It will take some time, 10 minutes, write fast. First, write down step 1. Identify the acquirer. Identify the acquirer. So write down as a result of entity A issuing 150 ordinary shares, as a result of entity A issuing 150 ordinary shares, entity B's shareholders own 60% of the issued shares of the combined entity. 60% of the issued shares of the combined entity. Okay. Then if you want to write calculation, 150 of the 250 total issued shares. 150 out of 250 total issued shares. Then write down the remaining 40% are owned by entity A's shareholders. The remaining 40% are owned by entity A's shareholders. Therefore, it is a reverse merger. Entity B is accounting acquirer. While entity A is legal acquirer. Then you write down step 2, implied purchase consideration. Step 2, write implied purchase consideration. That means what is the consideration payable to legal acquirer A? Implied, notional. We are not actually issuing anything to A, but we are only, for the sake of calculating the consideration and goodwill, what is the value of A Limited? Okay, what is the fair value of business of A Limited? So there is a note which says the fair value of the consideration effectively transferred. Should be based on most reliable measure. Okay. That means in order to calculate the fair value of the consideration for A Limited, it should be based on most reliable measure. I have two figures with me. One, I have got the fair value of B Limited share, which is 40 rupees. And second, I have got quoted market price of A share, which is 16 rupees. So which is more reliable? Quoted market price or fair value? Quoted market price of A. So write down the quoted market price of A provides more reliable measure than the estimated fair value of entity B. For entity B, fair value is given. For entity A, quoted price is given. So what is the fair value of this entity? The fair value of the consideration effectively transferred is equal to, this is a deemed calculation, okay? That this is the deemed consideration for entity A, which is 100 share of entity A given in the question. Issued capital of entity A 100 towards the end of the SOFP multiplied by market price 16 rupees. Okay, 1600. In this question, it will not make any difference whether you take 16 or 40. Why it will not make a difference? If you take 40, then these 100 shares are equivalent to 40 shares of entity A. And then 40 into 40, 1600. Because the share exchange ratio is 2.5. So this entity's 2.5 share is equivalent to 1 share of entity B. So 100 share will become equivalent to 40 shares of B and then multiplied by 40 rupees. Okay. But we'll not unnecessarily go into that calculation. Now next heading, write down calculation of goodwill. Very interesting question. Even though legal acquirer is A, but we are assuming as if it is an acquiree. What we are assuming? As if it is an acquiree. And then how do we compute the goodwill? We'll take consideration effectively transferred. Consideration effectively transferred is 1600. Now this is the value of 100% share, yes or no? This is the value of 100% share. One student had asked me, sir, why are we not adding NCI also? Good question. But there is no need. This is the value of 100% of the company. Na? When do we add NCI? When this value is for 80%, 70%, 60% share. This is already the value of 100% consideration. Then net recognized value of entity A's identifiable assets and liabilities. Or just write down net asset of entity A. Under that, come to the given question. Add following assets and liabilities. Current asset 500. This I will take at book value starting from the first line. Non-current asset I will take fair value 1500. And below there are two liabilities also after 3 lines. Current liabilities 300, non-current liabilities 400. So how much it comes to? 1300. Or you could have added share capital plus retained earning plus 200 rupees appreciation in the fixed asset. Welcome, that is also right. So goodwill is 300. That's it. Now you have to pass. In whose book? A. So write down in the books of A Limited, in bracket, legal acquirer. Legal acquirer. Right hand side, 2 columns, debit, credit. First, what I'll do? First, I will reverse the existing assets and liabilities, share capital and retained earning. Bring all balances to 0. So keep the entity A column in front of you. Go to the liability side. Current liabilities account debit 300. Non-current liabilities account debit 400. Retained earning account debit 800. Share capital account debit 300. Share capital 300. Everything is at book value. To current asset 500 book value, and to non-current asset 1300. Okay. Being assets, liabilities, share capital and reserves eliminated at book value. Okay. Any query? Now you incorporate the assets, liabilities of entity B at book value first. Book value. Non-current asset account debit 3000. Current asset account debit 700. First two items. To current liabilities 600. To non-current liabilities 1100. And to equity share capital, now pay attention, how many shares we have agreed to issue to this company? 150. This share you have issued. So this will come in your books, 150. And the face value is 3 rupees. Face value is 3 rupees. 300 divided by 100 means face value is 3 rupees. 450, and remaining amount you adjust in reserve or other equity. Equity to other equity 1550. Done. Now write down third entry. In the third entry, what we'll do, we will incorporate the asset, liabilities, goodwill, share capital of A Limited. Assets and liabilities will record at fair value wherever fair values are given. So write down, dear student, non-current asset account debit 1500 in bracket fair value because it is given. Current asset account debit 500. Goodwill account debit 300. Goodwill account debit 300. To current liabilities 300. To non-current liabilities 400. Now pay attention. How much share capital I will write here? I will write the same share capital because we are in the books of A Limited only. How can this number of shares change? Yes or no? This is what I was telling you. This will be given to you. So you just take it again, same figure, 100 into 3. And balancing figure you transfer to other equity, 1300. Okay. Yes. This is will be given to you in the problem of absorption because this is the balance sheet that is given to you. Now, based on these three entries, prepare SOFP. Write down consolidated SOFP. Consolidated SOFP as on. Consolidated SOFP as on 30th September 20x1. As on 30th September 20x1. Draw the format first. Format. assets, note number, amount, note number for writing share capital and other equity if you want, otherwise ignore it. In this question, I am writing directly in the main page only, but otherwise what you will do in the exam, you will write in the form of notes with all the details, and if possible, draw statement of changes in equity. Okay. So dear student, write down non-current asset. Keep the question in front of you. Non-current asset of entity A I will take at fair value 1500, and entity B I will take at book value 3000. So total comes to 4500. Yes or no? 4500. Goodwill 300. Current asset, both companies book value. Current and asset, both companies book value. 500 plus 700. 500 plus 700 is how much? 300. Sorry, 1200. Total 6000. One line blank. Equity and liabilities. Equity and liabilities. Equity share capital. Equity share capital 250 share of INR 3 each. 250 share you understood? 150 shares issued, 100 existing share, 750. Other equity 1300. Other equity 2850. Check the calculation, you will get it 1300 plus 1550. Non-current liabilities 1500, current liabilities 900. Say yes. Yes. $6,000. Now we will take a break.